Hello and welcome. You're watching KYC. I'm Harsh Saita. With me is Anushi Vakaria, and today we're going to be diving deep into Arisinfra. It's a newly listed company. That's point number one. And IPO listings have come in thick and fast, right, at us. So analyzing some of the businesses, some of the models, and trying to understand where they likely be, maybe not just today, but maybe 2-3 years from now, and how some of those businesses are looking today, as well as what they could look like 2 to 3 years from now, plus understanding what kind of guidance is starting to be given out. Because what will eventually happen is some of these businesses which haven't given guidances because they just got into listing mode will now, after maybe a week or 2 or 3 weeks of listing, are now entitled to start giving some form of guidance. So what could those be? Also with regard to understanding risks better. So I'm going to start off with why have we picked up and what I want to know with regard to where Arisinfra is concerned. One is there's a huge concentration risk. Let me put it out there. In terms of states, the top 3 states, Maharashtra included, contributes to 95% of the top line of Arisinfra. So huge geographic concentration. In terms of client concentration as well, the top client contributes nearly 20% of the revenue. The top 3 contribute nearly 40% of the revenue, and the top 10 contribute a very, very large, significant chunk in terms of revenue. And we'll look at some of those numbers as well. As we go through the company, I'll try and unwind some of those numbers. Now, the third piece is the large working capital requirement that we're seeing, and that has ballooned as the company has grown. Is that a concern? Well, clearly. And is this sustainable? What are the ways and means in which they are evolving in terms of the current business to try and take care of that large working capital requirement? Because the model isn't too bad. They don't store any of their material which they are selling, but the transport cost and the transport time is when the working capital gets blocked, and it's a large chunk when it comes to that versus the market cap as well as the top line. Now let me also talk a little bit about the risk on entry barriers, because that is the other key piece with regard to any business. Now, when you're looking at a business which is looking to scale and scale quickly, and if ROEs and ROCs were to improve, that will be a big risk, because if the barriers to entry aren't strong enough, then you could well see multiple players come in very, very quickly and disrupt the business of the current incumbent. So is competition being addressed in a good fashion? There's a heavy reliance on limited number of suppliers that they have. That's the other problem. And I just want to understand the overall guidance with regard to growth, margins, where they see the business going, and how they see the cash flow unwind also happen. So we'll look at all of that and more on KYC today with regard to Arisinfra over the next half hour or so. But first, let me explain what the company does. And it's a pure B2B company, which is it provides a service to other businesses within the real estate infra space, within the infra building space, and what they provide is construction materials to some of the infra as well as building or real estate companies. Now they're focusing on digitizing this, especially with regard to orders. What they do is they ensure timely delivery of orders of each of the building materials that you will require. So it's not like something that you require on day 5 you will get on day 2. If you require something on day 2, they'll give it to you on day 2, and thereafter when you require something on day 5, they'll give it to you on day 5. So it's a bulk kind of procurement kind of business that they do. Cement, steel, concrete and aggregates, those are largely what they deliver. They're also they also provide steel and other raw materials which are required for the purpose by large builders or contractors which are in this space. They use a proprietary tech platform to enable this, and that is also further enabled by instant messaging. But what is evident is that it's a B2B business. Now let me bring in Anushi here, because Anushi, there are B2B businesses in this space, and those businesses also have B2C models. Explain the model to us first before I go ahead and try and talk specifically about this company's business model. Just give us the understanding of B2B versus B2C and how this model works.
Right. So if you are looking at Arisinfra in particular, it, as Harsh just mentioned, that it has no listed peers as such, since it's in B2B. Now here, the main, if we are looking at the relationship, is between the vendors, wherein it procures the materials from, and then it caters to these certain clients. So it includes the likes of L&T, major construction players that we are looking at. So that is how the company's model essentially works. So it buys this materials from large base of vendors and manufacturers across the India, and these vendors includes the steel, cement, construction, chemicals across these segments that we are looking at. In fact, top 10 vendors of these contribute nearly half of the total purchases that we are seeing. Now, who they are catering to especially, that is important. Now, real estate developers, this includes the likes of infrastructure contracts as well, which includes companies that build that are building for roads, bridges, buildings, and more. So some of these top customer names also includes the likes of Capacit'e Infraprojects, Kumar Infraprojects, Afcons, Wadhwa Group as well. Now, do note that the company has a higher retention rate in terms of whether repeat customers are concerned. 80% or odd so was the mix that we had earlier seen, which has now come down to the levels of 70%. So that is the kind of business model, Harsh, that the company is building on, right?
Perfect. And what's the B2C model in some of the similar businesses that we see? Say a Shankara Bilcon, for example. Give us that perspective.
So over here, what is happening in the B2C now, here the vendors which are there, they directly have the clients, and that is how they are referring to. So here is how the company is different, because it's a platform provider essentially, right?
Yeah, absolutely. Okay. There's some amount of tech enablement. There's no doubt about that. but does that mean that there is enough moats? Really, that's the question that we'll probably try to address, and that will likely be one of the concerns that we'll look at. But let's now look at the metrics that we look for when it comes to Arisinfra. We'll start off with the income statement, the balance sheet, the cash flows, and we look at key metrics here. How much growth are we seeing in terms of customer count, in terms of material that they are selling, etc. Shareholding, street cred, valuations, and thereafter outlook. In the outlook, we'll look at the risks as well as the moats, whether the moats are strong enough and whether the risks are large enough, and thereafter that should give you a better perspective on how one should look at the business. But Anushi, start off with the income statement.
So, you know, in terms of where the FY25 metrics are concerned, we are looking at a significant improvement in terms of these numbers are concerned. In fact, you have some of these numbers flashing on your screen. From FY25 to 24, we are overall, from the 3-year perspective, we are seeing a 19% of a CAGR growth, while EBITDA in the last 2-3 years or so has remained flattish. In fact, we've looked at negative numbers also in the past. From FY24 onwards, they've seen about a 13 crore of an EBITDA, which inched upwards to 58 crore, which has brought their EBITDA margins from 8% to almost no margins that we'd seen in years of like FY22 and FY23, while net profit in the last 3 years have remained in the negative. It's the first year in FY25 where they clocked in about a 6 crore of a profit. So there is some growth that we are seeing, but how sustainable is this? What is the kind of growth guidance that we are seeing in terms of revenues, in terms of margins, is something that we should be watching out for, because 7.6%, this margin figure that we are looking at in FY25 is a first positive that we are seeing, apart from the 2% earlier. So sustainability in terms of margins is something that we should be watching out for.
And the top line, because what we saw in FY23 was a top line of around 746 crore. That dipped to 697 crore in FY24. Thereafter came back to 768 crore in FY25. So even the top line has been a bit choppy, at least in the last 3 years. Can we see a linear growth, and how strong? Because essentially on platform businesses, you would reckon that the growth will be strong. Because that's the basis on which they make their very, very thin margin, which they generally make. So one would have to understand this better, that is margin really the priority, or is top line growth really the priority, or is it going to be a mix of the two? Can margins go up along with top line to give that kicker to the bottom line? So some of those aspects will obviously need more clarity. But let's look at the balance sheet now, and you'll see how equity, and this is the 9-month FY25 balance sheet, viewers. So, beg your pardon, we don't have the full year FY25 numbers yet. So, 9-month FY25, that's how the balance sheet looks. You look at the borrowing number, it's 323 crore on a top line of approximately 750 odd crore. So, clearly that's a concern. You're also looking at a wafer thin cash balance which they are sitting on. A lot of that borrowing goes to fund working capital requirements, and the working capital requirements have ballooned. So I would be very, very cautious with regard to the way this balance sheet is shaping up on a sub 2000 crore market cap company. Clearly not looking very, very healthy. By the way, the numbers exclude lease liabilities. We did have that flashing on your screen, but that's something that you also want to quickly note. You want to take us to operating metrics?
Right. So
Anushi.
if you are looking at the operating metrics, I'll start off with the daily dispatches. Now, while that has seen a pickup in terms of where the FY22 to 25 picture is concerned, that has seen an increase. But, you know, it's the, as Harsh pointed out, to the working capital, that remains a concern. Net working capital days, if we see, that remains at 110 days or so. FY24, the figure was at 120. Now, what essentially the company is doing, firstly, when it's receiving orders first, it is making the payment and then it waits for the payment to come back. So we are looking at this paradigm in terms of where the net working capital is. Total debt to equity also, it is in the range above the one-time level that we are seeing. In fact, in FY24, the number was 1.9x, 1.4x was a number that we'd seen in FY25. What is the expectation in terms of debt to equities is something that we should be watching out for, considering that these IPO proceeds, some part of it was also used to repay the borrowings which were there. So that is on the key operational metrics that we are looking at. Quick touch up on the ROE also. Now that is in the range of 5% or also that we are looking at 5.7%. This is the FY25 figure that we are looking at. What is the outlook for this one? Also an important metric to consider for the overall return ratio performance that we usually give to the viewers in our KYC metrics, right?
Yeah, so maybe not the most appropriate when it comes to understanding what the return ratios will be, because we've got negative return ratios for a couple of years. It's a platform business. We appreciate that, and therefore maybe that ROE number not the best to look at the moment, but you would want to see it maybe 2-3 years from now. If the ramp up in ROE is substantial, you could well see this number looking very, very good, and suddenly things could well change. And that is the method on which platform businesses are generally valued. So if you call this a platform business, if you do, then we'll have to wait and watch as to how that evolves. But let's look at cash flows now. Those don't look encouraging at all. The cash flows have been weak. You look at the EBITDA number, it's on your screen. On the 9-month basis, we don't have that absolute EBITDA number, but nonetheless, what we're trying to underline is that operating cash flow number just doesn't seem to be kicking through. And why is that so? Is because receivables have been extremely high. It started off in FY22 when receivables stood at around 261.5 crore. That increased by roughly 28 crore in FY23, increased by another 45 crore in FY24. So that unwind with regard to receivables doesn't seem to be happening. Payables in proportion haven't gone up or ballooned in substantial fashion. So it's not like we can leverage on that and reduce the working capital requirement. That's not happening. So clearly cash flow from operations is not kicking through, and that's really the concern when it comes to this one. Only 1 year in which you saw around a 25-27% odd CFO to EBITDA. You want to see a better pickup on that. So we'll have to wait and watch with regard to this metric and how it's evolving. But that's the very big question, Anushi. Shareholding.
Let's talk about shareholding now. Of course, we'll have limited set of data in terms of, you know, the past performance, since it's a recent listing that we are looking at. But in terms of where the promoter holding is concerned, that's a 38% number that we are looking at. FII is about 22% of a mix, while DIIs have about 6% or auto of mix, and public usually at the end holding about 35% stake in the company. But given the limited history, we are giving this a neutral rating as of now.
Absolutely. Now let's look at street cred. Now very limited, right? Because this recently listed, but 222 was the IPO price. Stock is down 27% from there. Listing price was 205. Stock is down another 20% from there. So clearly a thumbs down with regard to this one. Unfortunately, no performance following the IPO. I'll also quickly cover valuations. The estimates seem to suggest that the EPS in FY26 will be around 8.5 rupees and around 9.8 rupees in FY27. If that were to play out, you're looking at a price to earnings multiple that's reflecting at the bottom of your screen. And the other piece also is that some of the other players in the space are certainly trading at a premium to this price. So on the valuation metric, it's certainly looking decent. It's not looking bad at all because of those IPO highs, and IPO was subscribed, there was interest, so it's off the IPO highs, and your price to earnings ratio seems to be quite decent. You want to cover outlook, Anushi?
Okay, so we've divided this into moats and risks, as Harsh had earlier mentioned about it. Now, in terms of where the outlook is concerned, now, if you look at the existing client wallet share, the company does say that it wants to increase this, the focus being on the margin picture going forward. Or, of course, a new client addition is also something that we should be watching out for. Scale up in terms of where the technology is concerned is also going to be another factor we should be watching out for the company to report more revenue growth going forward. This includes widening its value chain as well. Now, in terms of where risk is concerned, just at the top of the show, we did mention that a large part of the geographic concentration lies in 3 particular areas and top 10 customers contributing significantly to the revenue. So that's a risk concern that we have. Along with that, what's the overall outlook in terms of the working capital is something that we should be watching out for, considering that the short-term debt is used to fund the working capital requirements which are there currently. So overall picture on this is something that we should be considering, right, Harsh?
Absolutely. Okay, so now let's quickly sum it all up, stack it up in terms of KYC ratings. That's how it shapes up. Doesn't look entirely pretty, but what we're going to do is speak with management, and maybe that gives us some amount of comfort on some of the metrics that we've put out. But it gives us a 3.5 on 8 with regard to our KYC ratings. Let's bring on board Mr. Srinivasan Gopalan, CEO, Arisinfra Solutions, joining us as we speak. Mr. Gopalan, first off, welcome. Good morning. Great having you here.
Thank you for inviting me.
Sure. So I want a better understanding of how is it that your working capital requirements continue to rise. Is there any plan with regard to having a better control over working capital, or that is just the nature of the business? Give us that perspective first off.
So so I was hearing the analysis of Aris just prior to me logging in.
Yes.
As far as the working capital is concerned, that is one of the largest focus. And in this business, there are only 2 things you need to see: profitability and working capital. So you had mentioned what is the priority of the management, whether it's the top line growth or the bottom line growth. So it's a combination of both, keeping the working capital intact. And if you see, the working capital has only come down over the years. You need to appreciate one thing, sir, that we are a 4-year-old company. I mean, probably one of the fastest to come into the public domain and answer all these questions. So we are publicly just opened up everything. So if you look at it from last year's, the net working capital was around 120 days, which we have been able to bring it down to 110 days. And we can give you a thing that over the next 12 to 18 months, we intend to get this down to 90 to 95 days. And there are various ways in which we can do it. One is, of course, the last 12 months working capital, if you sit down and analyze, we are almost at 90 to 95 days. The second thing is we have repaid around 205 crores of debt. And that allows us to bring in a lot of non-fund based limit. And as you mentioned in your analysis, that the purchase side working capital, that is the payables, have not increased substantially. That also helps because we will have non-fund based limits, LC, discounting, so on and so forth. So we are very, very well poised to reduce this working capital days from the current 120 to around 90 to 95 days in the next 18 months.
And can you just give us some more of a picture on how you'll be able to, you mentioned that the debt picture is also one of the aiding factors, but how are we seeing the shift from 120 or 110 days or also to this 90 to 95 number that we are looking at just for this year in particular?
So there are going to be two factors, right? So I didn't say that 90 to 95 this year, right? Over the next 18 months is where we will reach the 90 to 95 days number. Now there are two ways in which we will do it. One is, as you rightly mentioned, the concentration that you mentioned, that the top 10 customers. The more we diversify, our dependency on the customers reduces, and that also helps us in managing the DSO days, which is the receivables days. And on the payables day, I mean, we are currently at a 23, 24 days. We can easily take that to a 45 to 60 days over the next 18 months. And a 10-day saving on the debtor side and a 20-day saving, I come to a 90-day working capital cycle.
Okay, so that's the overall picture that we are seeing on the working capital. Just want to get a sense on your debt also, current debt levels, if you can mention. Of course, the IPO proceeds helping you. And what's the kind of debt to equity ratio also that we should be expecting forward? Currently, we are seeing about 1.4 times of a multiple. Just give us a detailed breakdown on all these parameters as well.
So if you look at 2024, we were at 1.995, as you rightly mentioned in your analysis, which has come down to 1.45 in March. And if you look at June, we are at zero point 0.1. And because of the proceeds that we had from the IPO, we will be between 0.5 to 0.75% is our sweet spot where we would want to keep the debt to equity ratio.
Mr. Gopalan, give us perspective. Growth, margins, where does this go? Because you're off a small base. Also, what's happened in FY24? Because that year was a year of degrowth. Explain that to us.
Super. I mean, that's a very good question, and also answers your question on whether the management is concentrating on the top line or the bottom line.
Yes, sir.
Right? 2023, you said to 740 crores, and 2024, we were at less than 700 crores. And it is very important to analyze the product mix at that point in time. In 2023, the amount of steel and cement that we sold was close to 30 to 35%, whereas that has come down in 2025, that has come down to 11%. So steel is a very, very easy thing to increase your top line, right? One truck of steel is like 25 to 27 lakhs, whereas one truck of aggregates that we sell, aggregates means the stone, sand, and other things, it is 2,500 rupees. So it is very, very easy if you have a component of steel at the top line and you can increase the top line. So the focus of the management has been very, very clear on the bottom line. And that was the reason why there was a degrowth from 2023 to 2024. And answering your question on whether it's going to be linear going forward, I mean, we think we have a good mix of products that we have come up with, where the margins are around 7.5 to 8% at an EBITDA level. We look at a growth of 40 to 50% consistent over the next 3 years on the top line. And our EBITDA margins, which are currently between 7.5 and 8%, we believe that we would stabilize that in the next 18 to 24 months at around 9.5 to 10%. So that's how we'll keep growing. Also, please appreciate that before the IPO, the only equity that was there in the company was 150 crores. With that, we were doing a turnover of around 750 to 800 crores. Now, with this IPO proceeds coming, there is a lot of fuel for us to grow. However, I want to clearly mention that we are a very cautious company. We will grow keeping the bottom line and the net working capital days in mind.
40 to 50% top line growth, margins go from 7.5 to 9.5. That's the larger guidance for the next 3 years, Mr. Gopalan. Correct me if I'm wrong, but I want to quickly, I have only 30 seconds here. How the barrier to entry is low. How are you addressing that risk?
So I don't think the barrier to entry is low. It's very, very important. The barrier to entry is low if you have money and you're dealing with steel. Steel is something where you just need to call someone and say, yaar, gaadi udhar pahuncha do. That's not what we are dealing in. We are dealing in complex materials like aggregates, RMC, where there is a lot of service element involved. There is a lot of coordination, lot of quality things that we need to do. So the entry point is very, very difficult for people to get into the area that we are in. The other thing is, if you look at our customer list, which you saw in your analysis, all of them are large listed contractors. The minimum thing that these people require is a 3-year balance sheet. We have been able to get into these because of the legacy. Ronak Morbia, who's our CMD, he and his father have been in the business for 50 years in the past. So all of that has helped us to enter into these large contractors, which otherwise it's not going to be easy for a new company to come in. And deep domain knowledge. I think all the three promoters, I mean, my CFO, my CMD, as well as myself, all we have done in steel, cement, RMC, aggregates in our lives. Bal usi mein safed hua hai.
Okay, so point taken, but completely out of time. This has been a great chat. Thank you so much for coming and speaking with us, but completely out of time on this edition of KYC. I want to quickly flag off a couple of things. If it does a 40% CAGR over the next 2 years, FY27 top line will be more than 1400 crore from the current 768 crore, and they'll likely do an EBITDA of around 140 crore on a market cap of 1800 crore. But that's all, folks. Frankly, out of time completely on this edition of KYC. Thanks so much for tuning in.